I like that, Doug. I'm going to give you a tough choice. Do I pay my credit card debt or do I pay my student loan debt first?
Well, student loan debt typically is at a lower interest rate and possibly tax deductible depending on how much money you make. So when you look at that in the good debt versus bad debt category, I'm not a big proponent of paying down very rapidly tax-deductible debt that's at a low interest rate. And typically credit card debt is at a high interest rate and certainly not tax-deductible. So in order, what I always tell everybody is to focus on the interest rate first. Put everything you owe down and mark it in interest rate order. What people do, though, is they put it in balance order. And many times what they're doing is they're trying to pay down things with the balances and ignoring the interest rates. And so they're paying, and it takes a lot longer to pay that off. So if you just turn everything into interest rate order, top to bottom, and focus pay the minimums from the bottom up and focus every other dollar that you can at the top, you'll have a much greater way to pay everything off faster.
You know, Gary, you have something interesting to say about credit card debt, about how it's almost paying yourself.
Yeah, you know, for many people, the best investment you can make is paying down your credit card debt. I mean, why is that true? A, it's a guaranteed interest rate. Why is it guaranteed? Because you know you're not going to pay someone a sum of money. It's a high interest rate almost always, unless you have a teaser rate. And for many people, particularly in a market like this, the good news is people are going to start focusing on their whole picture and say, wait a minute, why do I need to play with uncertain markets when I can guarantee myself an 8, 12, 14% savings by paying down debt?
Nobody believes me when I say you can get a guaranteed rate of return. You can by paying your credit card debt. Okay, guys, great job. You've emailed us your questions all week about your money, and we're going to put them straight to our panel. That's coming up next. Saving cash, growing your nest egg, protecting your money. It all sounds good. Your questions keep rolling in, and it's time to get some answers. Back with us again, Doug Flynn, Gerri Willis, and Laura Rowley. Okay, Doug, I'm going to give you this first question from Twilla. She asks, we have a 401k plan, and 100% is in company stock. I've heard that we need to diversify. We're 39 years old, and we want to retire in our late 50s. Company stock, 100% in a 401k.
Well, I'm glad that she's heard that she needs to diversify. That's the first thing that you have to focus on, is get it out of there. Our normal recommendation is no more than 3 to 5% of your money. Well, because there have been too many people who have worked at Lehman, WorldCom, and all those Enron, who thought while it was going up that this is the greatest thing ever. And when you have everything in one place, your income is tied to that company, the money they're giving you is probably tied to that, and then to put your own money in there too, you could end up with zero, no matter how great you think the firm is that you're working for. So you have to get it down to 3 or 5%, and then you have to either hire a financial advisor by going to CFP.com and searching for one that you could feel comfortable with to help you if you don't know how to do it yourself.
Or you can go to CNNmoney.com and get an asset allocator there. That'll help you too if you want to do it on your own. Tricia from Arizona says, my 401k is with Principal Funds. That's a kind of mutual fund company. I've been told it's not protected by the FDIC. What's wrong with this picture, Gerri Willis?
Well, your 401ks normally are not protected by FDIC, period.
It just doesn't work that way. I mean, it's hard for people to understand, but it's not a bank.
So you have to be careful about what selections you're picking up. Obviously, fees matter. So you're mentioning Principal. They often have very high fees, but that might be the only set of choices you have. But within it, everyone has aggressive options and conservative ones. And if you're concerned about risk, being more conservative among their choices is the way to go. You know, people unfortunately are now painfully recognizing that losses in their tax sheltered accounts, in addition to being losses, are not even tax deductible.
All right.
So that's another good reason.
Another thing to think about. Let's move on to the next email from Tom in Indiana. I'm trying to get as many of these questions in because these people really want access to you guys. He asks, I have a CD that will mature in about 2 weeks. I plan on renewing it, plus adding a substantial amount of money. Since money is getting tight right now, I'm thinking about holding on to it for a little while to see if the rates go up, then buy one. What do you think?
I think you should hold on a little bit. With the bank consolidation we've seen, these banks are cash starved. We're starting to see interest rates start to creep up, 4, even 5% on certain CDs. So I'd take it out, I'd wait a little bit, and then I would roll it in when you see the best deal.
Good news for savers. I love that. We haven't had good news for savers lately. Jennifer asks, I'm 29 years old and I have 2 private student loans of $180,000 and $96,000 with variable interest rates. I make $170,000 a year and contribute the max to my 401k. That's good news. My company does not match my contribution given the state of the market. Should I suspend contributions? I have to stop right there. One-word answer. Do you suspend?
No.
Yeah. Why not?
Well, you're saving for your future. She's earning a relatively high income, so therefore the tax deduction's incredibly valuable. And the student loans probably have a very low interest rate.
Right.
So it might be one answer, which is no, but there are many reasons.
Right, exactly. You know, is there any reason to stop contributions to your 401k, Doug?
Well, if cash flow is that tight and you absolutely have to protect the house and your entire livelihood, that might mean then you have to delay your retirement. If you were thinking of retiring at 60, you're going to have to go at 62. You have to know what the effect is. But yeah, I think if you're going to lose your home, that might be a reason. But barring that, you have to realize that again, for every $3 you cut back, you're only going to see 2 of it because of the tax deduction that gives you. So people think I'm going to cut out my $600 a month 401k contribution. You're only going to see about $400 on average of that. So is it going to do it for you?
Right, right. Okay. Let me move on to another question that I know people are asking about because they're in trouble right now. Having a hard time finding money. The banks don't want to lend. Where do you go for emergency money? You don't have the emergency fund. Mom and Dad aren't kicking in any cash. What do you do?
That's really tricky because if, for example, you've lost your job, you're not going to be able to get a home equity loan. You're not going to be able to get a home equity line of credit. You might have some possibilities. I mean, over the last few years, we've seen the rise of these peer-to-peer lending websites like prosper.com. You may find somebody who...
They don't have any backing from the federal government. I mean, there's nothing standing behind
But you're looking to borrow money, correct?
I am.
You know,
if you're in a...
Other choices you might look at, obviously, if you have securities, you might want to sell them. You know, there's a question about whether you're selling them at a loss or whether you're doing something most people shouldn't do, which is margin the account. You might have whole life insurance policies, which I rarely recommend, but if you find yourself with it, there might be a source of borrowing at a relatively modest interest rate. And of course, as you kind of ruled out family lending, well, there's a time and a place to kind of take a look around and say we're
That's
family.
the easy money if you can get to it, right?
Some of those websites will handle the details of those loans between family members so you don't end up with both a financial loss and a relationship loss.
That's great news. Okay, well, great job, guys. Really appreciate your help. And I want to tell our viewers, keep those emails coming. You can also send us iReport questions. We want to hear from you. Head to ireport.com/issue1. Ask a question, share a comment. Hey, you can even share your tips on how you're getting by during these tough economic times. Bottom line, we want to hear from you. Retirement accounts are shrinking.
We are the little guys who seem to have to suffer for the fat cats, the Wall Street executives who are making all of this money and who ran amok.
How so many Americans are being affected and what you can do to protect your 401k.